In 1951, a 20-year-old kid took a train to Washington on a Saturday. The building was locked. A janitor let him in. And what happened in the next 4 hours changed the history of investing forever. Here's what almost nobody tells you. The greatest value investor who ever lived, and his teacher, made their fortunes on the same tiny company. A car insurance business. Not glamorous. Not exciting. But it made Benjamin Graham richer than all his other investments combined. And it later became Warren Buffett's crown jewel. So what did they see that everyone else missed? And why did Buffett make a mistake that cost him over $1 million? Stick with me, because the third part of this story is the one most investors never learn. Right, one company. Two legends. Let me take you back to 1948. Benjamin Graham, the father of value investing, runs a fund called Graham-Newman. And he does something strange. He put $712,000 into a single company. Geico. That's about a quarter of his entire fund in one stock. Now here's the irony. Graham wrote the book on diversification. Never bet too much on one name. And yet, he broke his own rule. Why? Because Geico wasn't like other insurers. Most car insurers sold through agents, who took a fat commission. Geico sold directly, by mail, to careful drivers, government employees and military. Lower costs. Safer customers. A structural edge. Draw, normal insurer pay agent commission higher cost, versus Geico sell direct by mail lower cost. And that one decision, that broken rule, became the single most profitable investment of Graham's career. His $700,000 stake eventually grew to be worth more than $400 million. Graham himself admitted the irony. The one time he concentrated, it beat every diversified bet he ever made. But here's where the story gets personal. Warren Buffett was Graham's student at Columbia. And he noticed his teacher sat on Geico's board. So the curious kid did something bold. He hopped a train to Washington on a Saturday when the office was closed. A janitor let him in. The only person there was a man named Lorimer Davidson, a Geico executive. And instead of shooing the kid away, Davidson spent 4 hours explaining exactly how insurance makes money. Sketch: 20-year-old Buffett knocks Lorimer Davidson 4-hour lesson arrow to float. That lesson lit a fire. Buffett went home and put $10,282 into Geico. That was about 2/3 of his entire net worth. 2/3. On one stock. And it worked. Within a year the stock climbed and he sold for around $15,000. A 50% gain. Nice, right? Except, it was one of the worst decisions he ever made. Because if he'd held those shares, they'd have been worth over $1 million 20 years later. That mistake taught Buffett a lesson he never forgot. Selling a wonderful business is usually a terrible idea. But the story isn't over. Fast forward to 1976. Geico, the Golden Company, is nearly bankrupt. It had grown greedy. It insured riskier drivers. It didn't set aside enough money for claims. And the stock collapsed, from around $61 a share, down to just $2. Wall Street was running for the exits. And what did Buffett do? He did the exact opposite. He was greedy when others were fearful. Berkshire Hathaway bought in roughly $45 million for about a third of the company. Right, be fearful when others are greedy. Be greedy when others are fearful. He wasn't gambling. He knew this business cold, he'd studied it since he was 20. The low-cost model was still intact. It just needed fixing. A new CEO, Jack Byrne, cleaned house. And Geico recovered. Draw, panic, stock at $2, Buffett studies the moat, buys 1/3 turnaround recovery. Then in 1996, Buffett bought the entire rest of the company, the half Berkshire didn't own, for $2.3 billion. Geico was now his. Completely. And here's the real magic, the thing Davidson taught him in that locked office. Insurance companies collect premiums today, but pay claims later. In between, they hold a giant pile of other people's money. Buffett calls this float. And a well-run insurer can invest that float for years, for free. Geico's float became a river of cash flowing into Berkshire's investments. That's how you buy Coca-Cola and Apple and dozens of other businesses, using money you don't technically own yet. This is the secret most people miss about Buffett. He's not just a stock picker. He's an insurance man who understood that a boring car insurance company could quietly fund an empire. A dull business. A structural edge. Held for decades. That's the whole game. So here's the one idea to carry with you. The best investments are rarely exciting. Geico didn't win with a flashy product. It won with a simple, durable cost advantage, a moat that lasted for decades. Graham saw it. Buffett studied it, lost it, and then reclaimed it. And the lesson from Buffett's biggest regret is this: when you find a truly great business, the hardest and smartest thing to do is nothing. Just hold on. Right, find a great business. Then do nothing. Now I'm curious. What's one boring business you'd happily own for 20 years? Drop it in the comments. I read every one. And remember, this is educational content, not financial advice, so always do your own research before you invest $1. If this changed how you see boring companies, hit subscribe. Tomorrow, we're breaking down a mistake that cost investors billions, and almost nobody saw it coming.